A Random Walk Down Wall Street. Before I read this book, so I need to explain why I read this book. And so first, I'd like to share my point of this book and my opinions. And second, so how can I apply to the stock market in reality? And last, and I'd like to share some information what I'm thinking, and I need some feedback from you guys. Enjoy it. First, the preface. It has now been over 35 years since I began writing the first edition of A Random Walk Down Wall Street. The message of the original edition was a very simple one. Investors would be far better off buying and holding an index fund than attempting to buy and sell individual securities or actively managed mutual funds. I boldly state that buying and holding all the stocks in the broad stock market average was likely to outperform professionally managed funds whose high expense charges and large trading costs detract substantially from investment returns. And now, over 35 years later, I believe even more strongly in that original thesis, and there is more than a six-figure gain to prove it. I can make the case with great sympathy, and investors with 10,000 at the first of 1969 who invested in the Standard & Poor's 500 stock index fund would have had a portfolio with 422,000 by 2006, assuming that all investments were reinvested. A second investor who instead purchased shares in the average actively managed fund would have seen his investment grow to $284,000. The difference is dramatic. Through March 31, 2006, the index investor was had by $138,000, an amount almost 50% greater than the final stake of the average investor in a managed fund. Why? Then, a ninth edition of this book. If the basic message hasn't changed, what has? The answer is that there have been enormous changes in the financial instruments available to the public. A book meant to provide a comprehensive investment guide for individual investors needs to be updated to cover the full range of investment products available. In addition, investors can benefit from a critical analysis of the worth of new information provided by academic researchers and market professionals made comprehensible in prose accessible to everyone with an interest in investing. There have been so many bewildering claims about the stock market that it's important to have a book that set the record straight. So far, I felt something, and it's actually I have been investing stock market. So maybe this year, April 1st, because as you guys know, there was COVID-19 pandemic, so I got the funds getting down. It's like plunged, and so I was really embarrassed and some panic at that time. So I'm looking for how can I manage my assets in the near future, and I found I need to invest my asset to the stock market, and I got money and I made some profit a little by little. Yes. Okay, next paragraph. Over the past 35 years, we have become accustomed to accepting the rapid pace of the technological change in our physical environment. Innovations such as cellular and video telephones, cable television, compact discs, DVDs, microwave ovens, laptop computers, the internet, voice over internet protocol, email, and new medical advances from organ transparent and laser surgery to non-surgical methods of treating kidney stones and unclogging arteries have materially affected the way we live. Financial innovations over the same period have been equally rapid. In 1973, when the first edition of this book appeared, we did not have money market funds. Now, accounts, ATMs, index mutual funds, ETFs, tax-exempt funds, emerging market funds, life cycle funds, flowing rate notes, volatility, derivatives, inflation protection securities, equity, REITs, Roth IRAs, 529 college savings plans, zero coupon bonds, financial and commodity futures and options, and new trading techniques such as portfolio insurance and program trading, to mention just a few of the changes that have occurred in the financial environment. Much of the new material in this book has been included to explain these financial innovations and to show how you as a consumer can benefit from them. Well, this 9th edition also provides a clear and easily accessible descriptions of the academic advance in investment theory and practice. A new chapter, chapter 10, has been added to describe the exciting new field of behavior finance and to underscore the important lessons investors should learn from the insights of the behavioralist. In addition, a new section has been added to the present practical investment strategies for investors who have retired or are about to retire. So much new materials has been added over the years that readers who may have read an earlier edition of this book in college or business school will find this new edition rewarding reading. This edition takes a hard look at the basic theories of earlier editions of the random walk that the market prices stocks so efficiently that the blindfolded chimpanzee throwing darts at the Wall Street Journal can select a portfolio that performs as well as those managed by the expert. Through the past 35 years, the thesis has held up remarkably well. More than 2/3 of professional portfolio managers have been outperformed by the unmanaged S&P 500 index. Nevertheless, there are still both academics and practitioners who doubt the validity of the theory. And the stock market crash of October 1987, as well as the crashlet of July 2002, raise further question concerning the ventured efficiency of the market. This edition explains the recent controversy and re-examines the claim that it is possible to beat the market, concluded in Chapter 11 that reports of the death of the efficient market theory are vastly exaggerated. I will, however, review the evidence on a number of techniques of stock selection that are believed to tilt the odds of success in favor of the individual investor. The book remains fundamentally a readable investment guide for individual investors, as I have consulted individuals and families about the financial strategies. It has become increasingly clear to me that one's capacity for risk bearing depends importantly upon one's age and ability to earn income from non-investment sources. It is also the case that the risk involved in most investment decreases with the length of time the investment can be held. For this reason, optimal investment strategies must be age-related. Chapter 14, entitled A Life Cycle Guide to Investing, should prove very helpful to people of all ages. This chapter alone is worth the cost of a high-priced appointment with a personal financial advisor. My debt of gratitude to those mentioned in earlier editions continue. In addition, I must mention the names of a number of people who were particularly helpful in making special contributions to the 9th edition. They include Kevin Langfleet of the Bogle Research Institute and Kyaur Gurum of the Bangalore Group, who helped me revise the update all the facts and the figures in the book. I'm also grateful to John Americas and Alan Lenderly of the Vanguard for their helpful comments on retirement investing. The next many sentence, the author, thanks to many people. It's like my wife Nancy, that has made for the most important contribution to the successful completion of the past 5 editions. Something like that. Okay, so next, finally we read some real thing, the acknowledgement from earlier edition. So we're gonna see some earlier editions knowledge. Okay, let's do this. My debts of gratitude to the practitioners, financial institutions, and academic colleagues who have helped me with the earlier editions of this book are numerous in both number and degree. Here, I acknowledge the many individuals who offered extremely valuable suggestion and criticism. Many researcher assistants have worked long in compiling information for this book. Especially useful contributions are made by Sharon Arntos, Karsten Bottas, Jonathan Curran, Barry Feynman, Eden Hugo. Oh, there's a lot of names. Thanks to the people. So, okay, a virtual contributions was made by Patricia Tyler, a professional writer and editor. And then, so you're gonna see the part 1 stocks and their value. First, the foundations and castles in the air. What is the cynic? A man who knows the price of everything and the value of nothing. Oscar Wilde, Lady Windermere's fan. In this book, I will take you on a random walk down Wall Street, providing a guided tour of the complex world of finance and practical advice on investment opportunities and strategies. Many people say that the individual investor has squarely a chance today against the Wall Street professionals. They point to professional investment strategies using complex derivative instruments and the news report of accounting fraud, corporate scams, so month takeovers, and the activity of well-financed hedge funds. This complexity suggests that there is no longer any room for the individual investor in today's institutionalized markets. Nothing could be further from the truth. You can do as well as the expert, perhaps even better. As I will point out later, it was the steady investors who kept their heads. When the stock market tanked in October 1987, and then so the value of their holdings eventually cover and continue to produce attractive returns. And many of the pros watched their shift during the 1990s using derivatives strategies they failed to understand, as well as during the early 2000s when they overloaded their portfolios with overpriced tech stocks. This book is succinct guide for the individual investor. It covers everything from insurance to income tax. It tells you how to buy life insurance and how to avoid getting ripped off by banks and brokers. It will even tell you what to do about gold and diamonds. But primarily, it is a book about common stocks, an investment medium that not only provided generous long-run returns in the past, but also appeared to represent good possibilities for the years ahead. The Life Cycle Investment Guide described in Part 4 gives individuals of all age groups specific portfolio recommendations for meeting their financial goals, including advice on how to invest in retirement. Okay, next. What is a random walk? A random walk is one in which future steps or directions cannot be predicted on the basis of past actions. When the term is applied to the stock market, it means that short-run changes in stock prices cannot be predicted. Investment advisory services, earnings predictions, and complicated chart patterns are useless. So actually, I really agree this sentence. Okay, on Wall Street, the terms random walk is obscenely. It is an epithet coined by the academic world and hard insultingly at the professional smooth-facers. Taken to its logical extreme, it means that a blonde-floated monkey throwing darts at the newspaper's financial page could select a portfolio that would do just as well as one carefully selected by the experts. Because in my case, I have been working in the chemical industry, so we need to predict the trend of the chemical market. So every day we check the oil price, interest rate, and some logistic things, some economic things, trend, and diplomatic stuff. So it's really hard to expect it. So how they can go, something like that. Okay, next paragraph. Now, financial analysts in pin-striped suits do not like being compared to barred-faced apes. They retort that academics are so immunes in equations and Greek symbols, to say nothing of the stuff pores, that they could not tell a bull from a bear even in a china shop. Market professionals arm themselves against the academic onslaught with one of two techniques, called it a fundamental analysis and technical analysis, which we will examine in part 2. Academics parry these tactics by obfuscating the random walk theory with 3 versions: the weak, the semi-strong, and the strong, and by creating their own theory, called it new investment technology. This last includes a concept called it beta, and I tend to trample on that a bit. By the early 2000s, even some academics joined the professionals in arguing that the stock market was at least somewhat predictable from after all. But still, as you can see, there's a tremendous battle going on, and it's fought with deadly intent because the stakes are tense for the academics and bonuses for the professionals. That is why I think you will enjoy this random walk down Wall Street. It has all the ingredients of high drama, including for tunes made and lost and classic arguments about their cause. But before we begin, perhaps I should introduce myself and state my qualifications as guide. I have drawn on three aspects of my background in writing this book. Each provides a different perspective on the stock market. First, my professional experience in the field of investment, analysis, and portfolio management. I started my career as a market professional with one of the Wall Street leading investment firms. Later, I chaired the investment committee of an insurance company with 800 billion of assets, and for many years served as a director of one of the world's largest investment companies with over $1 trillion of assets. These perspectives have been indispensable to me. Some things in life can never fully be appreciated or understood by the virgin. The same might be said of the stock market. Second is my current position as an economist, specializing in securities market and investment behavior. I have acquired detailed knowledge of academic research and founding on investment opportunities. I have relied on many new research findings in forming recommendations for you. Last, and certainly not at last, I have been a lifelong investor and a successful participant in the market. How successful I will not say for it. It is a particularity of the academic world that professional is not supposed to make money. A professional may inherit lots of money, marry lots of money, and spend lots of money, but he or she is never supposed to earn lots of money. It's unacademic. Anyway, teachers are supposed to be dedicated, or so politicians and administrators often say, especially when trying to justify the low academic pay scales. Academics are supposed to be seekers of knowledge, not of financial reward. It is in the former sense, therefore, that I should tell you of my victories on Wall Street. This book has a lot of facts and figures. Don't let that worry you. It is specifically intended for the financial layperson and offers practical tested investment advice. You need no prior knowledge to follow it. All you need is the internet and the desire to have your investment work for you. Investing as a way of life today. At this point, it is probably a good idea to explain what I mean by investing and how distinguish this activity from speculating. I view investing as a method of purchasing assets to gain profit in the forms of a reasonably predictable income and or appreciation over the long term. It is the definition of the time period for the investment return and the predictability of the returns that often distinguish an investment from a speculation. A speculator buys stocks hoping for a short-term gain over the next days or weeks. An investor buys stock likely to produce a dependable future stream of cash returns and capital gains when measured over years or decades. Let me make it quite clear that this is not a book for speculators. I'm not going to promise you overnight riches. I'm not promising you stock market miracles. Indeed, a subtitle for this book will have been the Get Rich Slowly but Surely book. Remember, just to stay even, your investment have to produce a rate of return equal to inflation. Inflation is United States and thought out. Most of the developed world fell to the 2% level in the early 2000s, and some analysts believe that relative price stability will continue indefinitely. They suggest that inflation is the exception rather than the rule, and that historical periods of rapid technological progress and peacetime economies were periods of stable or even falling prices. It may well be that little or no inflation will occur during the first decades of the 21st century. But I believe investors should not dismiss the possibility that inflation will accelerate again at some time in the future. While productivity growth accelerated in the 1990s and early 2000s, history tells us that the pace of improvement has always been uneven. Moreover, productivity improvements are harder to come by in some service-oriented activities. It still will take 4 musicians to play a string quartet and 1 surgeon to perform an operatory throughout the 21st century. And if musicians and surgeons' salaries raise over time so well, the cost of concert tickets and appendectomies. Thus, it would be a mistake to think that upward pressure on prices is no longer a worry. If inflation were to proceed at a 2 to 3% rate, a rate much lower than we had in the 1970s and early 1980s, the effects on our purchasing power would still be devastating. The following table shows what an average inflation rate approximately 4% has done over the 1962-2006 period. My morning newspaper has risen 1,090%. My afternoon Hershey bars has risen 15th, and it's actually smaller than it was 1962. When I was in graduate school, inflation continued at the same rate. Today's morning paper would cost more than $2 by the year 2020. It is clear that if we are to cope with even a mild inflation, we must undertake investment strategies that maintain our real purchasing power. Otherwise, we are doomed to an ever decreasing standard of living. So far I realized something. So when I start the investment, I thought, so I'd like to get profit. It's like at least the interest rate in the bank, or maybe the 2 or 3% in inflation rate or GDP growth rate. But I got the more profit than what was expected. And so I think so when you guys trying to invest, and so you need to calm down to never expected you guys to be rich as soon as possible. So you need to get some strategy to clear what is the priorities, why would you like to get the money, purpose. Those things more easily make some criteria and standard and strategies. Okay, next, let's move on to the next paragraph. Investing requires work, make no mistake about it. Romantic novels are replete with the tales of great family fortunes lost through the negative or lack of the knowledge on how to care for money. How can forget the sounds of the cherry orchards being cut down in the Chavez Great Plain? Free enterprise, not the Marxist system, caused the downfall of the Renevsky family. They had not worked to keep their money. Even if you trust all your funds to an investment advisor or to a mutual fund, you still have to know which advisor or which fund is most suitable to handle your money. Armed with the information contained in this book, you should find it a bit easier to make your investment decisions. Most important of all, however, is the fact that investing is fun. It is fun to pitch your intellect against that of the best investment communities and to find yourself rewarded with an increase in assets. It is exciting to review your investment returns and to see how they are accumulating at a faster rate than your salary. And it is also stimulating to learn about new ideas for products and service and innovations in the forms of financial investment. A successful investor is generally a well-rounded individual who put a natural curiosity and intelligent interest to work to earn more money. So